If you've ever sat through a capital raise deck or an exit pitch that was wall-to-wall charts, you already know the trap. The numbers might be correct. The model might be impressive. And still, nothing moves. No follow-up. No urgency. No offer. Today, we're talking about why that happens and why. In the world of small and mid-sized businesses, narrative is often the difference between a deal that could happen and a deal that actually happens.
Because spreadsheets prove the past, but they don't automatically make someone believe in the future. And investors aren't really buying historical performance. They're buying the belief that the business is going to create more value tomorrow than it does today.
That's the core question underneath almost every investor Q&A, right? Whether you're talking to a bank, a family office, private equity, a strategic buyer, or an acquisition entrepreneur, everyone is quietly asking, why should I trust that this business is going to be worth more later?
Exactly. And in SMB deals, that question is even more intense because information can be messy. The founder is often deeply tied to relationships. Systems might be evolving. Reporting might not be perfect. So the story isn't a nice to have. It's how uncertainty gets resolved.
Let's set the table. Business owners often think they're selling equity, debt, assets, or cash flow. But what they're actually selling is confidence. Because money is emotional, even in finance. Someone has to feel safe enough and excited enough to commit.
And that's why every capital raise and every exit is a story. Even if it's never labeled that way. The pitch is basically, here's what's true today, here's what could be true tomorrow, and here's why we're the people who can make tomorrow happen.
So let's break down the mismatch. Numbers are great at answering questions like, what happened, how much, how profitable. But the moment you start thinking about an investment decision, a different set of questions shows up.
Right. Questions like, why does this matter? Why now? Why this company? Why this team? Why will this work? Those questions live in narrative. And they're the questions that lead to yes or no.
And here's the big thing people overlook. Investors remember stories. They don't remember your spreadsheet tabs. No one's sitting at dinner saying, you should have seen their depreciation schedule.
They're saying, this is the company that expanded from one city to a dozen states because they solved a problem competitors ignored. That kind of sentence sticks. It creates a mental picture. It creates momentum.
Let's talk about risk, because we're really talking about risk. Most deals don't implode because someone can't do math. They stall or die because perceived uncertainty stays too high.
Yes, every transaction is basically a risk reduction exercise. A persuasive narrative lowers perceived risk by explaining things that spreadsheets can't fully explain. Like why customers keep buying, why growth isn't a one-time spike, why competitors can't copy the advantage next week, why the market is expanding, why timing matters, and why leadership can execute.
And when uncertainty goes down, confidence goes up, and confidence doesn't just feel nice. Confidence becomes valuation. Confidence becomes better terms. Confidence becomes speed.
Which is why two companies with similar financials can get totally different outcomes. One tells a clear, believable story of future value. The other just reports history and hopes the buyer connects the dots.
Okay, let's separate the two big scenarios, raising capital versus selling the business, because the narrative is related, but it's not identical.
When you're raising capital, a lot of founders unconsciously frame it like, we're asking for money. But the better frame is, we're inviting you into the creation of future value. That shift changes how you present everything.
And it also changes the structure of the pitch. The strongest capital stories tend to move through a few stages in a really natural way. You start with current reality, who the company is today, then the opportunity, what's happening in the market and why it matters.
Then strategy, how you actually win, your edge, your plan, your execution logic. And then the outcome, what success looks like for everyone involved. And notice how that ends. It ends with outcomes, not the funding request.
Because investors buy outcomes. Money is just a tool. So instead of leading with we're raising $5 million, you lead with what the $5 million does. It funds the expansion, the capacity build, the product rollout, the acquisitions, whatever the engine is.
It's almost like the funding amount should feel inevitable by the time you say it. Like, given the opportunity and the plan, Here's the sized tool we need.
Now exits. This is where a lot of sellers accidentally leave money on the table. They think the buyer is paying for what they've already built.
Sophisticated buyers are paying for what they believe can happen next. Future cash flow, future share, future synergies, future strategic value. The buyer is doing a forward-looking bet, even if they're using historic numbers to calibrate the risk.
So the narrative has to evolve. The seller's instinct is, look at what I built. But the buyer wants to hear, imagine what you could build with this platform. It's a subtle difference, but it's massive.
Because that's where strategic value comes alive. A buyer starts picturing distribution leverage, cross-sell, operational improvement, add-on acquisitions, pricing power. If you help them see that future clearly and credibly, you can create real incremental value.
Now let's get practical. If narrative is so important, what do persuasive advisors and persuasive founders actually do differently? There are a handful of habits that show up again and again in great capital and M&A conversations.
First one, they don't rush. They pause before responding. Silence is underrated. When someone asks a pointed question and you immediately start talking, you can sound defensive or rehearsed. When you take a beat, you signal confidence and thoughtfulness.
A pause can basically say, I heard you, I'm considering what you mean, and I'm going to answer the real concern. Which leads to the second habit. They use stories, not just stats.
A stat is fine, but a story gives the stat meaning. Revenue grew 40% is information. But we went from serving one city to 12 states because we solved a distribution bottleneck nobody else addressed is persuasion. It's transformation. People remember transformation.
Third habit. They speak in outcomes. Average presenters talk about the raise, the product, the process. Great presenters talk about the results the capital unlocks. They make the future concrete.
Fourth, they make the other person feel smart. That's huge. Nobody likes being pushed into a corner by someone trying to sell them. But people love arriving at a conclusion themselves.
So instead of doing a 40-minute monologue, they ask questions that invite ownership. What concerns you most? What part of this opportunity feels most interesting? How does this fit your investment thesis? If someone helps build a conclusion, they trust it more.
Fifth habit, they don't hide the downsides. Pretending there's no risk destroys credibility instantly. Every serious investor assumes there are risks. The question is whether you understand them and can manage them.
So you say it plainly. Customer concentration is high today. Here's the plan to reduce it over the next 18 months. Margins dip for these reasons, and here's what we changed. Transparency builds trust, and trust supports valuation.
Sixth, they listen to understand the question behind the question. Investors often ask something tactical, but they mean something strategic. If someone asks about churn, they may really be asking whether cash flow is predictable. If they ask about the founder's role, they may really be asking how transferable the business is.
And seventh, they give people space to decide. Pressure creates resistance. If you're constantly trying to close, you can accidentally make the opportunity feel less stable. Confident communicators present, then let the room breathe. Questions that come after that silence are usually the real ones.
That's the funny part. The goal isn't to win the argument. It's to help someone make a good decision. That's what persuasive communication is when it's done ethically, reducing uncertainty, not manipulating someone.
Let's pull this together into a useful framework. If someone listening is thinking, okay, I get it, but how do I build a narrative? There's a simple progression that works for most SMB capital raises and exit processes.
Start with the problem. What pain or inefficiency exists in the market? Then the solution. How does the company uniquely solve it? Then evidence. What proof shows this is real? Customer traction, repeatability, unit economics, retention, operational metrics.
Then opportunity. How big is the remaining market and what's the expansion path? Then strategy. What exactly will capital or new ownership do to accelerate growth? And finally, outcome. What does success look like not only for the investor or buyer, but for customers, employees, and the broader ecosystem?
That last part matters. When outcomes are clear, The deal stops feeling like a leap of faith and starts feeling like a logical step toward a shared win.
Which brings us to the advisor's role in all of this. Great M&A and capital advisors obviously do models and process and negotiation, but the elite ones are translators. They translate a complex real-world business into an investment thesis someone else can understand quickly.
They connect the dots from evidence to opportunity. They frame risk honestly. They make the future feel both compelling and believable. In the lower middle market especially, where businesses can be founder-centric and information can be imperfect, that translation can literally change the outcome.
So if you're a founder, here's a good gut check. If you removed your spreadsheets for a minute, could you still explain, in plain language, why the future will be better? Why now is the moment? Why your business is hard to replicate? Why your team can deliver?
And if you can, then the numbers become what they should be: support. Financials establish credibility. Due diligence verifies facts. But narrative gives the facts meaning. It's what makes another person want to join the journey.
Because in the end, people don't invest in a spreadsheet. They invest in a future they can picture, believe in, and choose to help create.